That was an excellent presentation, Chris. I am going to challenge a few of those points, but what I would say to begin with is that I got a bunch of ETFs, and for most of my family and friends, my recommendation is exactly the same. And the reason for that is that investing is hard. Investing is really hard. And I think that anyone who's actually tried to do it for any length of time appreciates that. It's something that's really easy to forget when you're, 10 years plus into a raging super strong bull market at the moment. It's a very, very dangerous time. We all feel like geniuses. There's a lot of people buying a lot of really crappy stocks at really silly valuations that have been extraordinarily well rewarded. So you make bad decisions and you get rewarded for that, and that can be particularly dangerous. So one of the things that I think is super valuable if you are going to be a direct investor is to appreciate just how hard it can be, not just intellectually, but also emotionally. I am actually going to make a pitch for direct investing here, but I think it's very clear to be upfront about those kinds of things. The thing with investing being hard, though, is, to quote Buffett, it's simple but not easy. There are concepts at play here, and you could spend years studying high finance and the rest of it. But the core concepts, the big concepts with investing, are eternal and they don't change. And of all the smart investors that we've had up here tonight, they're all singing from the same song sheet. So it's no surprise for me at all, having known these guys for a long time, that they do deliver such outstanding returns. Even when you have super, super smart investors doing super, super smart process, who are inevitably going to go through a bad patch, as Tony was talking about before. It's just how it is. But these concepts I think anyone can grasp. You've just got to understand that it is not easy. The great thing about the market is, as Chris was just saying, is that you can do virtually nothing. And someone quoted 8% as a long-term average. I've heard 10%. There's a range there. Well, let me tell you, the value of that over an extended period of time, particularly for anyone who is saving. By the way, saving's the best thing you can do to increase your wealth before you even think about investing. But investing and saving and doing that, 10% is going to do you extraordinarily well over time. But if you are going to make an effort to invest directly, well, and Doug talked about this at the very beginning, you need to benchmark. There's no point if I get an 8% return over the long term if I could have done nothing and got 10% in an index. One of the other great things that about compounding is that small amounts of percentage differences on an annual basis add up to significantly larger amounts. So while there's a bit of work to be done here, the rewards can be very substantial. So if I'm getting 10% per year, or I'm getting 15% per year, say, I'm going to have twice as much money after 15 years as someone who's getting 10%. 10, 15% doesn't sound like a lot, compounds out to a hell of a big difference. So there is, I think, value in trying to become a better investor. I think we all can become better investors. For me, I would also argue it's actually incredibly intellectually stimulating. It's not just about money and finance. I mean, the markets reflect real companies in the real world, whether you're into biomedical engineering, mining, retail, you name it. There are these dimensions that are represented on the market, and understanding how those cogs fit together and how they work and how that all relates. Fascinating, dare I say in a very nerdish way, fun kind of thing to do. So I think there's a lot of good reason to do it. Another thing about investing that's super hard is there's a massive dichotomy at play here in terms of the mindsets that are involved. So all the best investors have a couple of traits that are in common, but they seem mutually exclusive. If you're the kind of person, and let's face it, who isn't this kind of person, who wants multi-year, multi-bagger returns, when people are quoting for you the real success stories on the market, had you bought X, Y, and Z 10 years ago, these companies, and Matt talked to this before, although they've delivered incredible value, it has never gone up in a straight line. There are massive drawdowns along the way. So one of these characteristics you absolutely must have as a good investor is to have an incredible amount of emotional fortitude, that resilience to hang on to your shares as they fall 40%. And if you're me, that happens all the time. It usually happens the day after you buy the shares. It's just how it goes. But some of the better returns I've ever had have fallen into that category. It's normal. It's par for the course. So you need to have this massive conviction and an ability to sort of blinker out all the noise and sentiment changes and volatility of the market. On the other token, and Matt touched on this as well, was that you need to have an open-mindedness, you need to have a flexibility, you need to have a recognition that things change or my interpretation of the facts change, and that I need to be very agile at those points. And by the way, you're not wrong because the share price has gone down 40%. You're wrong because the very reasoning, your investment thesis, your argument for investing into a company was flawed, miscalculated, poorly imagined. When that happens, get the hell out. Don't try and wait. What most of us do is, I made a bad decision, I'll just wait for it to go back up a bit and then I'll sell. Stupid anchoring kind of stuff that we're all susceptible to. So it's this really weird combination of high degree of difficulty in some areas, emotional fortitude on one hand, and a flexibility and an ability to be fluid on the other. It's very, very, very difficult. One of the things that's been immensely valuable to me in becoming a better investor and trying to overcome these is basically just by being part of an investment club. And I've been fortunate enough to be a part of a few, and these things are phenomenally valuable. The first is the obvious one, is because you'll meet someone who's got an interesting idea that you may never have come across before. And there's been people who've given you some pitches tonight. I'm going to give you a bit of a pitch later on tonight, a stock that I think is really interesting. But it also gives you new ways of thinking, and I think, and this is very hard for us to accept, I think the best thing that can happen to me when I go along to a meet, catch up with some of my mates, is to pitch a stock and have them, pardon my French, crap all over it, to absolutely tear it apart and destroy it. My investment idea is either correct or it's wrong. And if it is wrong, that is going to be realized on the market at some point in time. And it's far better that I learn that in the safety of my friendship group. My ego might be a little bit bruised. I might not feel as smart, but let me tell you, that is a super, super valuable process. So it helps you avoid mistakes. It helps you build that necessary conviction that you need. I think one of the things that we also find about investing is that it's a very lonely pursuit. Events that like Owen has put on here today is super valuable, but they don't happen very often. They're very difficult. They're costly to organize, etc. So most of the time, we're sitting in our Ugg boots at home in front of a computer looking to try and connect. Anyone a member of the Aussie FinTwit community out there? Oh, get on it. Everyone who's been speaking here tonight has an account and they share their ideas for free and a lot of insights. It's super, super, super valuable. And I use it a lot and I get a lot of value out of it. The trouble with a lot of the networks that we see that are out there is, to my mind, is that they have two big flaws. The first is that even on some forums, and I'm not going to mention some other forums that are out there that might have to do with the temperature and a type of metal, but these kinds of forums, there's actually some really awesome contributors there. There really are. But good luck finding them and good luck unearthing that content. The structure is terrible. It's very, very hard to find the good stuff. The other problem, and the bigger problem really, is one of accountability. Everyone presents as an expert. Everyone feels like it's got an ulterior motive. Who's worth listening to and who is not worth listening to? Where's the credibility? How can I appraise that as someone who's coming on just online, looking at some random avatar name and working out who is this person, man or female, 60-year-old, 20-year-old, what are they doing? Why should I believe what they have to say? And so that's really the two key areas that we wanted to solve with Strawman. But another big part of what we wanted to do with Strawman is we wanted to bring a much greater level of rigor and process to the investment journey. And I think that is key. One of the concerns that a lot of people raised, and certainly we had in the very early days, was that why on earth is anyone going to share their idea? Why am I going to put my investment thesis out there to have people crap all over it and potentially be shown to be the idiot that I secretly know that I am, and I'm hoping that no one else finds out? I think actually there's huge value in doing that, and there's for a couple of reasons. The first one is that it actually forces you, it crystallizes your thinking. It forces you to put down in black and white a reason as to why you're buying it. Where there's a lot of stuff floating around in our heads, there'll be things that we like, things that we don't like, and we'll often just act on that. But without having putting that down in writing, it can be very difficult. That process also keeps you very honest, because new information will come to light. New interpretation of the facts will come to light. Prices will change dramatically. And one of the things that a lot of investors suffer from is thesis creep. I'm buying Afterpay because of X, Y, and Z. And then that turns out to not be so true. and the share price might move a little bit. Bad example. But let's imagine it's gone down. And then all of a sudden, I'm going to adjust my thinking, and I'm going to protect my ego, essentially, I'm going to suffer from this thesis creep, and hope becomes my investment strategy. So a clear, well-articulated, public investment case holds yourself to account. It allows you to stress test your ideas. It allows you also to leverage off the experience and expertise of a very large group of also engaged investors. And no matter how smart you are or whatever your background, there are huge holes in your understanding of the world. But when you combine all of that together, the sum really is greater than the whole, rather, is really greater than the sum of its parts. So yeah, we built Strawman, and I'm not used to using a Mac, Owen. Do I just press? Did I mention that I've got a technology company?
Nice screensaver.
Yeah. There it is. Thank you, mate. So we built Strawman, and we really. So, yeah, look, we built it and we wanted to solve these problems. It was only in June last year that we launched a very rough version of the beta. I'm really embarrassed when I look on that, back on that now, but it's come a long way. In fact, we're really proud of it for a couple of reasons. Just last week, we hit 5,000 users. We've got a very, very high engagement with those users. We got backed by a venture capital firm a few months ago. They've brought a lot more resources, not just capital, but also developmental resources and stuff to the fore. And also, if I can log in, we've had an incredible performance. And I think that's no accident. When you bring a lot of smart, engaged people together in a spirit of open-mindedness and collaboration, some really special things can emerge. If I can remember my password. Exactly what it is. Yes. It's about as complicated as that. So I'm not going to give you a huge run through on it. It's going to look very different in the coming month or so. We've got some really cool enhancements and changes happening. But we had a pre-alpha version with me and a few friends late 2017. It's done very well since then. But whether you look at the last 12 months, the last 6 months, the last 3 months, it's done incredibly well. And not just by a bit, it's about a 35% odd return on average relative to the benchmark, which in our case is the ASX 300. Both of these include dividends. So one of the important things for me with Strawman was that it actually yielded something that was practical, something that was actionable, something even if I'm not the hardcore investment nerd, I can just look at what other collection of smart, engaged people are doing and see what they think are the best stocks that are out there. And as I was saying to in the break as well, I think there are other sites out there that sort of have this gamification, these stock tip competitions. That's cool. But for me, what's hard about that is if we're just in a pub having a beer and someone tips me a stock, well, that's not good enough for me. I mean, why? Why do you like it? How much do you think it's worth? What can go wrong? What are the management like? What are the moats? What are all of these other things? And so what we wanted to do is we wanted to build company reports and a platform that not only people could share the tips, but their understanding behind those ideas. What's their investment thesis? What's their valuation? How has that changed over time? How is the community engaged with that? What's the peer review been on that? I can get on there like any social platform and say all kinds of nonsense, but our community's pretty cool and they'll downvote the hell out of that very quickly. So at least it's not going to pollute the news feeds of other people. So yeah, I thought what I'd do is I'd end with a bit of a pitch. Me and Owen, we did a series last year in Melbourne, and I think it was Promedicus, Nanosonics, and Afterpay, which turned out very well. But we set a high bar for ourselves. So Owen's gone with Xero this year. I'm going to go with PushPay. And the reason I'm going to go with PushPay, and this is in full disclosure, it's my largest personal holding. It's ranked #1 on Strawman. It has for a little while. So I'm not trying to pump this. In fact, if you would please acknowledge what I said before, if there is something I'm missing with this damn thing, let me know. The whole reason it's called Strawman is we want these ideas to be challenged. If you can't knock it down, my conviction only gets stronger. That's going to encourage me to sit through the tough times and probably even put some more money into that kind of thing. So that's my disclosure there. What you can see here, who uses Macs, honestly? is our consensus community valuation. It's been pretty consistent for a while, about $4.28, undervalued by about 29.2%. You can see all the contributors who have done that. Anyone on this platform can create a company report for any ASX listed company, but we try and aggregate it in a way that you can sort of see the hive mind, the whole, pretty simplistically. And we rank that by the number of votes and stuff that you've got. Let's look at my report. So you can see I think it's about $4.38. Why, you may ask? Well, you can read about it. I've given you the reasons why. You can see how that's changed over time. Yes, I've changed my mind. Anyone who does not understand the complexity of the world. It's that great JP Morgan quote when someone said, what do you do when the facts change? Well, I change my mind. Why wouldn't you? We see something really appealing about stupidly sticking to something, but when the facts change, you should change your mind. Anyway, here you can see that I've got a bunch of straws. These are all straws that I've posted, my rationale for it, how people have voted on it, etc. If you want to look at what the broader community in regards to this particular company have said, we actually rank these by the level of endorsement that they've received. And we're adding some more cool stuff in too. So these things will act a bit more in a Reddit kind of fashion where timeliness and other engagement factors really make sure that we've got a really powerful sort for you here. Who the hell am I? Well, if ever you're unsure, you can always click on someone. You can look at their account. You can see how they've performed. Is this someone worth listening to? What are the other recommendations that you've made? And yes, this is totally an excuse just to show you the performance that I've had so far on Strawman, which I've been fortunate enough to do rather well on. So what's the quick, without making you read all of that, although you can read all of that on Strawman, and you can read all of that for all of the stocks that are on Strawman and share your own ideas as well. It's that online place where you can connect with other people in a sensible and smart way. So I want to talk about PushPay. This is a very young company, 2011. It was formed over in New Zealand. This is a payment application for churches, for the faith sector. Believe it or not, this is huge business. PushPay estimate this to be worth about $2 billion in the United States. They feel confident that they can capture about $1 billion worth, about half of the market. It's incredibly fragmented. A lot of tithing and donations are done by passing the plate around with checks. It's insane in 2019, soon to be 2020. And they have been moving into that incredibly rapidly. In the trailing 12 months, they've just, as a Kiwi company, they have a different reporting schedule. But in the recent first half result, their trailing 12 months worth of revenues was $110 million. It was only back in 2011, I think, it was, in 2016, it was $10 million. So this thing has grown incredibly rapidly. So what? A little bit ho-hum in 2019, another tech company that's growing its top line very, very rapidly. I think what is different about PushPay is that they are a legitimate market leader in here. They have a solid first mover advantage, a very, very solid product, and they're actually managing to scale well. So I noticed Volpara's results came out today, very cool, another Kiwi company in fact, but their profit grew massively and their loss blew out even more so. Now there's subtleties with all of that, of course, but what PushPay has managed to do is they've managed to actually do this while keeping their costs very, very well contained. In fact, in the last 6 months, they actually saw their costs reduce by about 2%. Matt touched on the topic of inflection points before. These guys have now gone through that break-even phase. These are cash flow positive business. They're going to record their first full year of profitability this year. They've already done that on a half-year basis. They have zero debt. They've got $22 odd million worth of cash on the balance sheet, so they're incredibly well capitalized, very, very well positioned to make a few more acquisitions and augment their offering that's out there. And where they really differ, I think, with a lot of other companies that are out there, and I could bore you with average revenue per user growth and retention rates and all the usual SaaS metrics. They're good, is the short story. But the thing that I think is bizarre, unless I'm missing something with PushPay at the moment, is the valuation that it's trading on. Today, at present, it's come a little bit off its 2-year lows, but it's trading on a price to sales ratio of less than 5. Nearmap's on 10. Prometheus is on 60. Volpara is on 20. I mean, it's 2019. And these are the valuations that you're looking at. Not only that, but it is going to record a full year's worth of profit. making some assumptions, and my assumptions are written in more detail on Strawman. I think these guys are on a forward PE of about 38 or so. And this is a business that reckons it can grow tenfold before it hits maturity. This is a business that has very, very low risk. Anything could happen in Australia. We could enter in one of the worst, recessions we've ever had. The vast majority of the money comes from the US, and it comes from a very, very, very dependable source as well. So it's super safe, super reliable revenues. It's growing its top lines very, very strongly. It's past the break-even inflection point, which means that the profits are growing far, far greater than the top line, and the top line is already growing well enough, and you're getting that for 38 times earnings. So that's my pitch.